Hey, Renter Retires, it's Adam Schroeder here with another episode, joined as usual by Zach Lemaster, the founder and CEO of Rent to Retirement. And we have a special guest with us today. He is a real estate investor himself. His name is John, and we're going to be talking a little bit about his journey. John, thanks for joining us today.
Yeah. Thank you for having me on. Look forward to it.
Absolutely. So tell us just a little bit about when your journey started, how you really, when you started thinking about real estate, but also when you got really serious and, signed on the dotted line and got your first property.
Well, I've been investing for just over 2 years. At one point, I was actually looking for a primary residence, and my realtor is like, "Well, it's so difficult to buy a house during COVID. Why don't you look into rentals instead?" And it's funny, he wasn't the only person in that, I'm gonna say, like 3-month time span that put the real estate bug in my ears. So I read Rich Dad Poor Dad, and then through other influences, I jumped right in. I bought a 4-unit in, I believe it was August of 2021, and then that ended up being a tremendous amount of work. So then I've since kind of gone the turnkey new construction route, and it's fitting my lifestyle a lot better.
John, our goal here, and thank you for sharing that, is to bring on investors that, are basically, they're not yet expert investors, but they're also not brand new investors, but they're doing it, right? They're out there showing other people that you can invest in today's market. It's possible, and to offer some encouragement and some insight for people that are probably where you were in 2021, a few years back, just starting to get into the range, or getting into the point where you can make that first investment. So first investment, jumped right into a fourplex. Sounds like that was a lot of work, maybe something that you were personally rehabbing or things like that. I definitely want to dive into that. But before we do that, talk to us a little bit more about why real estate? So you read Rich Dad Poor Dad, as most of us have, or that's kind of a starting point to kickstart about just how to think about investing in money in general and assets versus liabilities. And it's a great read, obviously. If anyone hasn't read that, I encourage you to do that. And then Cash Flow Quadrant is a good next one. But besides your realtor telling you, hey, you should think about rental properties, why else did rental properties seem like an investment that you wanted to make? Was it a lifestyle thing, or talk to us more about the why?
Funny thing is, one of those other influences I ran into in life, he's a financial advisor. As much as I don't care for financial advisors anymore, he did give me some solid advice in saying there's only 2 ways you get out of paying taxes. It's through real estate or business. And at the time, I'm thinking, well, I don't know what for business I would start right now, but I can start real estate right now, and that's really all I needed to hear.
You don't like paying taxes, John? Is that what I hear? Or
it's not that I don't like paying taxes. If I can avoid it and defer it, why not?
So when you say that the quadplex was, a lot of work, like Zach said, were you doing a primary rehab yourself, and then, or was it in your local market, or was your first one outside of your local market? Kind of tell us a little bit about that first one.
Yeah, so it was in my local market. Originally, I kind of thought, okay, I'm getting property management. They'll be able to take care of some of the turnovers and so forth. But they left me very disappointed. And at that point, it was like, man, I got to just take massive action and get this place turned around. It was only 50% occupied. So, I started with the first unit, getting it ready to be rented. I got it ready, went on to the next one, and then eventually in, that 12-month span, I had tenants leave, thankfully, and then other tenants, they bought a house and moved away. I was able to turn over everything in this building. I took the rent roll from $1,300 up to what's now $3,500 a month, and cash flows, over $1,000 a month. Really, the DIY came out of just kind of limited resources. I didn't have, a contractor lined up right away. But by the time I got to the fourth unit, I hired everything out for that, and now it's been totally hands off. I found a property management company that serves me really well, and I'm super glad I went through with that decision to buy that place. And if I could buy 4 more just like it, I would.
Absolutely. So your next one, you mentioned that one was trouble. So you started going down the build to rent model. What led you to the new construction as opposed to just, getting rehab? Kind of what led you to that one?
Well, both methods work. However, I find a lot of peace of mind with new construction, because I've seen old water lines, old water drains, bad electrical. I've seen all that, and I know what it costs to fix it. So why not start off with something that's brand new? Your maintenance costs are going to be next to nothing for, the first 5 years, as long as you have decent tenants. And that's something you're going to want to own for 20, 30 years. So why not start there?
Yeah, generally speaking, with new construction, I like new construction as well, and that's where we put a lot of our investments in. Also, from a tax side, if you're doing things like accelerated depreciation, things like that, you get better tax benefits on new construction. But generally speaking, it's new construction is done in areas that are growing, that have high rental demand. You have less turnover and vacancy, certainly less maintenance, probably better appreciation both of rents and value. But the challenge is the price point. It's higher than, say, a Midwestern house. You're going to have to pay for a higher price point. It just means you might need to bring a little bit more capital to the table. Maybe there's some creative things you can do with less money down to acquire more properties that comes into your tax play. And I think these are some of the things that you're doing, John. And so as you've evolved, now you own multiple properties in multiple different markets, single family, multifamily, you're on this path just over a short period of time. I mean, just a couple of years, you've been able to work hard, save money, invest that money, and then use some creative strategies to continue to scale your portfolio, which has been really cool to watch the evolution. And it's not all been sunshine and rainbows. There's always obstacles, right? That happens with any investing journey. Like that's part of it. And we all try to learn from those and improve. But let's talk about some of the creative things that you're doing, both, from a lending side and from a tax side, and how that plays into your overall plan. Do you mind sharing a little bit about that?
Oh, I don't mind at all. So this year I was able to add 6 properties to my portfolio. I was fortunate to meet the qualifications for the 5 no money down Alabama builds, which are doing fairly well right now. The strategy there was I got to get ownership of these. I can afford to take that liability on my balance sheet, but over time the goal is to deleverage, and then while also doing that, I closed on a property, new construction down Lehigh Acres, and that's the same thing. I got to get ownership of it, and then over time I'm going to deleverage, and that's going to ultimately lead to the cash flow that everyone is looking to get.
Yeah, because you're not looking to retire today. And just to be specific for anyone listening, you used a loan product that is, well, it's not available at no money down any longer. The credit union still offers it at 5% down, so it's not 0 down like it was at one point in time, but it's still an attractive way to acquire multiple properties. However, those will very likely be negative cash flow when have such high leverage in the property. But what I heard you say, John, is that this is a way that you are obtaining ownership of more assets with your capital now, with the understanding that in the future you're going to have a larger portfolio, that your plan is to deleverage over time to cash flow more, but the goal is to buy now and own now, let real estate do what it does over time, and then reap the benefits from cash flow later. Is that the idea?
Absolutely. That one product allowed me to get 5 doors, whereas, I might have only been able to do 1 or 2 this year, and then I'd have had to do 2 or 3 in following years. So I would have missed out on that appreciation, loan pay down, and then the tax benefits.
And what are the tax benefits that you're utilizing with some of this new construction?
With my situation being a high earning W-2, my tax advisor kind of told me, hey, the way you make your income, accelerated depreciation is not going to benefit you a ton because you're not a real estate professional. However, I'm able to deduct the cost of heating, cooling, and kitchen appliances. So, for example, those 5 Alabama properties, that ends up being $72,000 in deductions that is going to wipe out my tax bill for this year and likely upcoming years. And by that point, I may even decide to invest in more properties to just continue deferring taxes on my portfolio.
That's huge, right? I mean, that's dramatic. And John, you know this because we've had multiple conversations, but like, this is where real estate, and this goes back to your financial advisor. That's, the two ways to legally not pay taxes or defer them is real estate and business, right? Those are the two ways. And real estate, I would argue, even has more benefits than business specifically. But I mean, you could actually do real estate as business and couple that with real estate. But the idea is to offset your taxable liability that you would otherwise pay to Uncle Sam and never see again, but instead use that money and reinvest it to actually earn income on it, keep it, earn interest on it, or income on it, or return on it, and furthermore, buy more assets with it to have more tax benefits. You get this snowballing effect. That's how wealth is created. And it doesn't happen overnight, but it does happen over a period of time of consistently doing that. And you're a younger guy, John, so you got time on your side, and you can weather the storm with a little bit of negative cash flow with a high leverage loan because long term, if you just hold these, they're good areas, they're new construction. Like at some point, these things will cash flow, and you're going to be building equity and these tax benefits. Like just running an ROI on that alone compared to the money you have down on it, regardless of cash flow, has got to be pretty high. I mean, I love that strategy. Anything you want to add to that, or?
I will add, at one point I had a Roth IRA. You can contribute post-tax dollars into that. They grow tax deferred. I make too much money to do that now. However, real estate's my new Roth IRA.
I like that. One last thing, because I just want to make sure the audience caught what you said. I talk about cost segregation, accelerated depreciation. Not everyone can do that, but or would benefit from that if they're not already pro. Obviously, there's the short-term aspect where you maybe could do something there. But talk to us about the appliances aspect. I want to understand a little bit more about how you're able to still have some large tax deduction from new construction in this scenario.
They're basically, I think they're classified as a capital expense. However, the tax code's written, certain things in a property are given a certain lifespan, and I'm assuming that the lifespan on these appliances is a lot shorter than your flooring, foundation, roof, etc. So we're able to deduct all those in the first year.
Yeah, I love it.
I mean, think about it. I mean, he just cash flowed $72,000 this year with the tax write-offs. That's not a bad yearly return there.
No, not at all.
I don't have the calculator on hand with me, but I know it's significant. So what are your future plans when you're looking at this? I mean, obviously you mentioned kind of rolling over the cash flow that you're going to be getting in the tax, buying more to get those tax benefits, but are you still going to be focusing on single family? Are you looking at going into multifamily? Are you planning on staying on the new construction route? Or, I hope to be a part of these conversations that you have, as we continue our relationship down the years, but what are your future plans?
I would say 5 years from now, I'm going to have a lot better equity stake, and I've considered, like my Lehigh property, I have a good bit of equity in that. Why don't I do a 1031 exchange and roll that into, an 8-unit, 10-unit multifamily somewhere? That way I'll get the cash flow then. Right now I'm not really cash flowing, but I do have equity. Then that's going to shift my portfolio more towards cash flow if I decided to retire early.
Yeah, and there's 8 to 10 units. You might be doing some rehab, and hopefully it doesn't end up like the quad. And I hope that's a little smoother process for that.
So basically, what I'm hearing is trading up, build a portfolio, own the assets right now, let real estate do what it does over time, and then likely go through a 1031, whether it's into more of a multifamily asset class or whatever the case is trade in the equity and scale up. And this just makes me think, just how wealth is built in real estate, and it just doesn't always really click for people in the beginning because I think. You have this mindset, but I'm constantly reminded, John, of people that are getting into real estate right now. A lot of the discussions we have with investors are like cash flow today, right? Like they're looking at a pro forma and an ROI, and they're saying, okay, well, this isn't this $150 a month with my 7.5 interest rate, 8%, whatever it is, like that's not a good ROI year one. And then they decide not to invest, or they get like hyper focused on that. And I just go back to think about, like, especially us buying right now. I don't necessarily invest for cash flow. Now, I don't want to be in a huge negative cash flow position if I don't have reserves. But I'm looking at it long term, just like you, John, where it's if I'm buying in a good area, with the property and I let leverage do what it does, where the tenant will pay that loan down and build equity, the house will appreciate, the rents will go up and increase cash flow over time, and then I'll maximize the tax benefits in the interim. I mean, just give real estate time and let it do what it does. But I'm not trying to retire on cash flow today from one house, right? I mean, that's not what it's about. You're kind of missing the big picture about how real estate builds wealth. And then you trade in your equity, as you mentioned. That's what wealthy people do. They maximize the tax benefit. They buy an asset like real estate that is tax efficient. They reinvest their money, meaning their both their cash flow and their equity, though. They change it in. They either pull their equity out with a HELOC, cash out refi, or they sell it in 1031 exchange it, and they buy more assets. And you get this compounding effect all along the way. You're maximizing your tax benefits in this tax efficient vehicle. And that's how people build mass amounts of wealth. And it doesn't happen overnight, but certainly within a 5 to 10 year period, you can create a pretty significant portfolio. I mean, John, let me ask you this first. Have you run, because we came out with a wealth tracker on our website that allows people to future project equity and cash flow. Have you played with that, ran any projections either with that or any other calculators to kind of see, like, let's say you didn't buy any other real estate, but let's like where you'd be in 5 to 10 years. Have you ran any of those numbers? Or do you even think forward about that? I mean, or is that something that you're just kind of like, I know it will improve, but I haven't really calculated things out?
I've kind of calculated with napkin math. I believe with my current portfolio, if 1 year from today, if everything went up 3%, that's a gain of like $65,000 in that 1 year. So if you compound that over time, if I didn't buy anything more, it wouldn't take very long for that to be a $5 million portfolio. And that's with not buying anything more.
Yeah, I think that's super interesting. I love looking at that too, just like acquiring more real estate, and you got to do this responsibly, right? I mean, you got to know your situation. I'm not saying buy just a bunch of bad deals, like have a strategy, but the more you can own, to John's initial point, the more that you can own. And then that starts to like compound every year where you look at, all right, it's the cash flow aside, if my portfolio of $1 million goes up 3% that year, that's a significant increase. If I have a $5 million portfolio and that goes up 3%, what about the leverage on a $5 million portfolio every single year? You could be paying that down 6 figures, right? You're basically building equity. And then you have the cash flow that should be going up year after year. So scalability, you have economies of scale in real estate, and it becomes this snowball effect as you continue to grow and add more doors to your portfolio. But sometimes people, again, at the very beginning, lose sight of that. The second part of this question, John, would be what advice would you give to someone who is kind of falling into that category that I just talked about? They're looking, and this is applicable to today's market where rates are high, cash flow isn't, and ROI maybe isn't super attractive because where debt is, and they let that paralyze them, where they don't do anything, but they've been thinking about real estate for years now. I mean, and they want to invest in real estate, what would you tell that person?
I mean, everyone says this, time in the market is better than timing the market. We just went over tax benefits and appreciation. If you buy now, you'll be able to harness those tax benefits and appreciation. But if you're going to wait 3 years for rates to drop, that just, in those 3 years, that property you end up buying is going to appreciate in value, and it's going to be harder to buy than if you just would have jumped in. Obviously don't invest recklessly, but get in if it makes sense to do it, and watch and see what it does.
I want to go back. Your first property you bought during COVID, you probably got a 3.5%, 4% interest rate on that, with rates being as low as they were, and then you went to the 5%, which had a much higher rate, and now you're buying more that are at that 7.5%, 8.5% potentially. Kind of what led you to, because as Zach mentioned, a lot of people get stuck on that interest rate, and especially as you had one and then you're thinking, I'm going to buy one with double the interest rate. What was there any particular moment or thinking that led you to just go, you know what, interest rate here doesn't really matter? Was there any one particular thing or a couple of things that helped you get over that?
Well, the thing of it is, you're not locked into this rate forever. You can always refinance, and as long as you can make the numbers work, that small number with a percent sign behind it doesn't really matter that much.
Yeah, in the grand scheme of things, right? I mean, an interest rate, it's like you look at the amount of interest you're paying, and you look at the pro forma and an interest rate. It's like you kind of assume, or people fall into the assumption that that's going to be how the property is always going to be, right? But it's all dynamic. As you mentioned, you can refinance. Rents will go up over time. That's all variable. But owning the property and actually having ownership of it is the key point. And what I've really the consistent trend I've heard from you, John, is that you're buying, right? You're consistently buying. It doesn't matter. Rates are super low or whatever the case is. You're maximizing your tax benefits. You're finding a way to own more real estate year after year, because that falls into your long-term plan. Let's hear a little bit about, I mean, there's been some obstacles with stuff. Real estate, you talked about some of the challenges of that first fourplex, and now you're at a point where it's successful, but it was a lot of work to get there. You worked with different contractors, different property managers, give us a couple pieces of advice from someone that's bought multiple properties in multiple different areas, whether it's a first fourplex or any properties later. Like what's some things applicable to a newer investor just to think about as they're getting started to build their own portfolio based on some of the challenges that you've had?
Oh, I would say to move strategically but intentionally. One of my mistakes is I bought 3 properties in like a 3-month span. So I was having to run around and get all kinds of paperwork, leases to get approved for loans. And that ended up being a ton of work. And then meanwhile, I had to, rehab this property. My advice to someone is start with one property and hold that for at least 6 months until you would consider getting another one. Just grow slowly and intentionally. Don't just run out there and deploy a lot of capital, because your first property might not go so well, and you're like, man, I don't know if I want to continue doing this. But just let it sit and see what it does. I'm willing to bet after 1 or 2, 3 years, you're going to be glad you did, and you're going to be ready to go do it again.
Yeah, and then the other thing that you mentioned is buying 3 properties over 3 separate months, because you got to go and get a new loan approval. Like, there's 2 sides of this. We always encourage people, and this is my opinion, to move at your pace, what makes sense for you. Sometimes, like if you're doing a 1031 exchange or whatever the case is, sometimes it makes sense, like you have to buy, or your goal is to buy multiple properties. And if you're going to do that at a period of time, it may make sense to try to do them simultaneously versus stringing them along. There's what is called a lender burnout, where you qualify for a loan, go through all this stuff, pulling teeth and, giving your firstborn child, all this stuff that these lenders want is so exhausting to have
80 different places to download documents.
Oh, to turn around and do it like 1 or 2 months later, like it's exhausting. And so, I do think most people that we see that are experienced buyer investors, whether they're buying one property or they're buying groups, they're doing it like during a period of time. And then they're taking a step back, as John mentioned, and they're evaluating, they're seeing how the property and the team is performing, but they're just giving themselves a break, you know what I mean, to then go and do it, because that could be quite exhausting. I don't know. I see that all the time. I know I'm having to do that now, actually, with some loans. I'm just like, man, I am just not. It's just not fun to deal with lenders consistently and deal with all those documents, and it's a lot of work to buy property sometimes.
So talk a little bit, speaking of the hassles, because a lot of people I talk with, maybe they've owned real estate for a little while. They hit their first issue. They have an eviction, or on a tenant turn, a tenant has done, some damage, and now they have to pay for it, and they don't love it. So their immediate thought is, hey, Adam, I want to sell my property. I want to get out. Real estate just might not be for me. What would you say to those people other than just keep holding in? Kind of what helped you get through it as you were doing the tenant turns on your quadplex? And do you have any advice for the people who are thinking that, like, is there a mental kind of change that you had as you go through those bumpy times?
Well, I mean, first of all, it's going to happen to anyone that invests eventually. Yeah. And here's the other thing. If you invested in index funds, you're going to have a lot worse volatility compared to dealing with, a handful of bad tenants. And if you're going to hold these properties 20, 30 years, yeah, you'll have a bad tenant here or there. But I'm willing to bet it's going to be a net win over time.
Yeah, absolutely.
John, if you let me ask you this, just to be a little bit self-serving here. You've certainly invested in some properties with rent to retirement, not all of your portfolio, but what are some benefits that our team was able to assist you with throughout your process, if anything?
It's certainly nice to get advice on how I'm growing my portfolio, but I found that there's a lot more hand-holding with these turnkeys. With my career being as busy and working so much and traveling, I don't always have time to be on the ball with everything, setting up inspections and so forth. So it's nice to always have someone to fall back on. And these properties are usually in nicer areas, whereas if you're going on the MLS, you're trusting an agent out of state, you don't always know what you're going to get. But I feel it's a lot safer and easier transaction with rent to retirement. And then there's always help after the purchase as well.
Yeah, that's important. We try to, while we remind people that, like, you're an investor, these are your properties. You're going to be the owner of them long term. So you need to know that, but we're always here to help you, if issues come up, but also more importantly, just staying engaged with you to help you strategically plan. Right. I think we put you in touch with John, a lot of different professionals from a tax side, from a legal side, from a insurance side, that has been able to, really make sure from a lending side, right, with some of the creative things you've done there, kind of put all these creative pieces into place and build your real estate professional team to scale your portfolio. Would you agree with that? Or?
Oh, absolutely. And I would say that the tax benefits I received have just been huge. Obviously we got to do a certain amount of legal stuff to keep yourself protected, because real estate's one of the most highly litigated sectors. But just the tax planning has made a huge difference in my wealth building journey.
I love it.
All right, John, anything else you would like to say to the investors out there, either the ones getting started or the ones who've been in it for a while? Any final thoughts that you want to share?
Just keep taking action. Make sure you're intentional with what you're doing, and don't take it too seriously too.
All right. Well, we appreciate you joining us today, John. I mean, it's great to be a part of your journey. I look forward to seeing what you do over the coming years. If you want to check out what we have, or if you want to book a time to, talk with us, just head over to renttoretirement.com and you can see everything we have. Schedule a call. We're happy to help you from A to Z. And just head on over to Rent to Retirement and check us out. Also, don't forget, if you have any questions that you want Zach and I to cover on future episodes, send those to podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. Really appreciate the time you spent educating yourself today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.